Did you know that nearly 40% of loan applications get rejected due to avoidable mistakes? Imagine spending weeks gathering documents, only to get turned down. Frustrating, right? Well, today we're making sure that doesn't happen to you. Whether you're looking for a personal loan, a mortgage, or business funding, getting approved isn't just about your credit score. Lenders are looking for specific factors, and once you understand them, you can position yourself as an ideal borrower. Let's break this down step by step, so you're not just applying, you're getting approved. First up, creditworthiness. This is the big one. Lenders assess your FICO score, typically ranging from 300 to 850 to determine risk. A score above 700 is considered solid, but here's what many don't realize. It's not just about the number. Payment history carries the most weight, making up 35% of your score. Just one missed payment can drop your score by 50 points or more. Then there's credit utilization, how much of your available credit you're using. Keeping this below 30% is crucial, but below 10%? Even better. Let's say you have a $10,000 credit limit. If you're carrying a $5,000 balance, that's 50% utilization, and lenders see that as a red flag. Paying down balances before applying can boost your score in as little as 30 days. Now, what if your credit isn't perfect? There's still a way forward. Consider secured loans, where you put down collateral or a cosigner with strong credit. Even credit builder loans can help establish a solid track record. Beyond credit, lenders analyze your income and debt-to-income ratio (DTI). This compares your monthly debt payments to your income. And ideally, lenders want this under 36%. If you're applying for a mortgage, they'll often allow up to 43%, but the lower the better. For example, let's say Liam earns $5,000 per month and pays $1,800 in debt. His DTI is 36%, which is right at the acceptable limit. But if Ava earns the same amount and carries $2,500 in debt, her DTI jumps to 50%, making approval much harder. Paying down debt or increasing income before applying can dramatically improve your chances. But here's something that surprises many borrowers. Lenders also scrutinize your employment stability. If you've had 3 jobs in 2 years, they might see you as a risk. Ideally, they want at least 2 years of steady employment. If you're self-employed, expect extra scrutiny. You'll likely need 2 years of tax returns, profit and loss statements, and bank statements. Lenders want proof of consistent income, so keeping your finances organized and up to date is crucial. Now let's talk about loan types. Not all loans are created equal, and choosing the right one can mean the difference between low interest rates and sky-high fees. If you're applying for a mortgage, you have options like conventional loans, FHA loans, or VA loans, each with different requirements. Need a personal loan? Some lenders specialize in debt consolidation, while others cater to high credit borrowers with lower rates. Business loans can range from SBA loans to lines of credit, depending on what fits your needs. And before you hit that apply button, always check your pre-approval options. Many lenders offer soft credit checks, so you can see potential rates without impacting your score. One last thing. Before you apply, do this one crucial step. Audit your credit report. Errors are more common than you think. 1 in 5 credit reports contains a mistake that could hurt your score. Dispute inaccuracies before applying, and you could increase your approval odds overnight. Now that you know exactly what lenders look for, it's time to take action. Which part of the loan approval process surprised you the most? Let me know in the comments. I read every single one. And if you're serious about getting the best loan terms, you won't want to miss what's coming next. Click the video on screen. It's a must-watch.